Hello, everyone. A huge warm welcome to you all. Thank you so much for coming to watch the video today. We have a really packed session ahead of us.
We really do.
Yeah, we're doing a deep dive into a company that has, fundamentally changed how we work over the last few years. We are talking about Zoom Video Communications.
It's been quite the journey for them, hasn't it?
Oh, absolutely.
Yeah.
But today, we aren't looking back at that whole pandemic boom. We are looking forward.
Right. Today, we are breaking down their Q4 and full fiscal year 2026 results.
Which they just released on February 26, 2026.
Exactly. And look, if you still think of Zoom as just that app you use for video meetings.
The one for the family trivia nights?
Yeah, exactly. If that's what you think, you are in for a bit of a surprise. Because the big headline here is their really aggressive shift from being a basic communication platform to what they're calling an AI-first system of action.
An AI-first system of action. I love that phrasing. It sounds very dynamic.
It does.
So let's unpack this. Before we get into the Q&A session, which is where the analysts really hold their feet to the fire, give us the lay of the land, what did CEO Eric Yuan and CFO Michelle Chang have to say in their prepared remarks?
Well, let's start with the financials, because the numbers tell a story of stabilization and maturity. For Q4, Zoom's revenue grew 5.3% year over year to $1.25 billion.
Okay.
And for the full fiscal year 2026, they grew 4.4%.
Now, seeing single-digit growth might not sound explosive to some people.
No, it doesn't. But you really have to look at where that money is coming from. Their enterprise revenue, so contracts with big companies, that grew 7.1%.
Oh, wow.
And it now makes up 61% of their total revenue.
So they are firmly entrenched in the corporate world now. It's not just the yoga classes and happy hours anymore.
Exactly. And the online business, which is those smaller businesses and individual users, that's finally showing signs of stabilizing with slight growth.
Which is a big deal, right?
It's huge.
Yeah.
Because it's the first time that segment has actually grown since fiscal year 22.
Right.
Plus, profitability is really strong. Non-GAAP income from operations was $490 million, which actually beat their guidance.
Right.
They have very strong operating cash flow of $355 million, and they are putting that cash to use. They repurchased 3.8 million shares in Q4 alone, and they intend to keep doing that at a minimum to offset dilution going forward.
Okay, so the bank account is very healthy, but what about the vision? You mentioned the system of action. What does that actually look like in practice?
So this was Eric Yuan's main focus in the presentation. The core vision is moving beyond just systems of engagement.
Where we just talk to each other.
Right. Moving from that to actually helping employees complete their work. And they outlined 3 priorities for this.
Okay, what are they?
First, elevate the workplace with AI, which includes the launch of AI Companion 3.0. Second, drive the growth of new AI products, things like the Zoom Revenue Accelerator. And third, scale their AI-first customer experience.
Customer experience, or CX. That seems to be a massive theme in tech lately.
Oh, it's huge for them right now. They mentioned that their ZCX deals, Zoom Customer Experience, are growing at high double digits. In fact, 7 of their top 10 deals in the quarter were competitive displacements.
Meaning they kicked another vendor out to take the spot?
Exactly. They also mentioned closing an acquisition of a company called BrightHire.
What do they do?
They bring conversational AI into the recruiting and hiring process, so it fits right into that workflow idea.
That's an aggressive move. Okay, so looking forward, what is the crystal ball saying for fiscal year 27?
They expect to cross a major milestone. They are guiding to cross the $5 billion revenue mark.
That is no joke.
It isn't. The range is 5.065 to 5.075 billion, which represents about 4.1% growth. They're also looking at operating margins staying healthy around 40.5%.
Okay.
All while continuing to invest heavily in AI monetization in what they call a post-pandemic refreshment cycle of their data center assets.
Okay, crossing 5 billion is huge, so that is the polished, prepared presentation. But as you know, the real insights usually come out when the analysts start grilling the executives. So, let's transition to the Q&A segment. We have gone through the transcript and pulled out the key exchanges so you don't have to read all the fine print yourself.
Yeah, let's do it. There were quite a few sharp questions this time around.
All right, first up, we had Arjun Bhatia from William Blair.
Right. Arjun went straight for the revenue question regarding AI. He asked specifically about AI monetization progress in FY27. He wanted to know how Zoom is thinking about it, especially regarding the custom AI companion and the broader portfolio adoption.
And Eric Yuan, the CEO, seemed pretty optimistic here. He clarified that while the standard AI companion is free,
Which is great for user retention, by the way.
Right, exactly. But the custom AI companion is a monetizable add-on. And they're seeing opportunities to attach AI to things like the Zoom virtual agent, Zoom phone, and the revenue accelerator. A specific detail that stood out to me, in their top 10 CX deals, 4 of them had already attached the Zoom voice agent.
That is a critical metric. It proves that companies aren't just buying the base platform, they are buying the AI add-ons immediately.
Yeah. Okay, next up was Alan Frykowski from BTI.
Alan was looking closely at the balance sheet. He asked about the Q1 deferred revenue growth guidance, which was around 1.5%. That seems a little low. So he asked what was driving that and what the assumptions were for enterprise versus online growth in FY27.
This was a fairly technical but strategically really important answer from Michelle Chang, the CFO.
Yeah, she explained that deferred revenue looks lower right now because they're giving grace periods to customers in large competitive takeouts.
Basically, to get a really big customer to switch to Zoom from a competitor, they let them use the service for free for a few months during that transition.
Exactly. So they are taking a short-term hit on the books to lock in a long-term client. She said this is highly intentional and very good for the long-term health of the business.
Makes total sense.
And for FY27, she noted there's a slight headwind from a white label partner churning, but enterprise is going to be the main growth headline. Online is expected to just have slight growth.
So the days of massive online expansion are over.
Pretty much.
All right, next question came from Peter Levine at Evercore.
Peter asked what I'd call the existential dread question.
Oh, yeah.
He asked about Zoom's moat against the big AI model providers who could theoretically just build their own collaboration suites. He also asked when net dollar retention, which is currently sitting at 98%, will start to go back up.
I found Eric's response to the moat question fascinating.
Me too.
He emphasized reliability, security, and ease of use. But then he got a bit spicy. He noted that while AI coding tools can build toys, replicating Zoom's mission-critical C++ code for real-time audio and video is extremely hard.
Basically saying you can't just ask a chatbot to rebuild their entire back-end infrastructure.
Right. It was a very strong defense of their technical stack. And on the retention side, Michelle stated it will rebound long-term via cross-selling phone and contact center. But she did admit there are some headwinds from that white label churn we just mentioned.
Okay, next up we had Siti Pinigrahi from Zuho.
CD asked for details on international revenue trends and what initiatives they have to re-accelerate growth outside of the U.S.
Michelle Chang broke the numbers down nicely here. Growth is actually happening across the board. Americas is up 6%, EMEA, so Europe, Middle East, and Africa is up 5%, and APAC is up 3%.
And to keep that momentum going, they are investing in local infrastructure, right?
Yes, like a new UK data center. And they're using products like Contact Center and WorkVivo to break into those international markets alongside a lot of channel investments.
It really shows that you have to be physically present with infrastructure to win those massive international enterprise deals.
Absolutely. Moving on, we had Alex Zukin from Wolf Research.
Alex asked a two-parter. First, about Zoom's ownership structure and investment in Anthropic, the big AI company. And second, about the sustainability of the growth they are seeing in phone and contact center.
This answer included a staggering number. Regarding Anthropic, Zoom recorded a $532 million gain from its investment.
That's $1 billion just from an investment gain. That is wild.
It really validates their strategy of partnering. Rather than trying to build every single AI model from scratch alone, they confirmed Anthropic remains a critical partner.
And on the growth durability.
Michelle cited actual wins against heavyweights like Cisco, RingCentral, and Microsoft. She mentioned the contact center growth is in the high double digits. And notably, 6 of the top 10 contact center deals also pulled through Zoom Phone.
So that bundling effect is really starting to show up in the data.
It is.
Okay, next question was from Josh Baer at Morgan Stanley.
Josh asked a strategy question about balancing horizontal tools, meaning features everyone uses, versus deep vertical solutions for specific departments like HR or sales.
And Eric explained that their AI foundational technology allows them to do both simultaneously.
Right.
They innovate horizontally with new features for everyone while leveraging that exact same AI architecture to monetize specific verticals like customer support and sales. He's arguing they don't have to choose one path. The tech enables both.
Which is the absolute ideal scenario if they can execute on it.
For sure. Next was Tyler Radke from Citi.
Tyler circled back to the custom AI companion. He asked if it's actually a meaningful revenue driver for FY27 and if they are realizing list prices or if they have to discount it heavily to get people to adopt it.
Eric confirmed it is a solid monetization tool, specifically for mid to large enterprises. The real value, he said, lies in the workflow builder, which connects Zoom to third-party apps and enterprise knowledge retrieval.
Right. He said it contributed to Q4 growth and expects it to help even more in FY27. And he didn't signal any heavy discounting, which implies the value prop is strong enough to hold the price.
Good sign for their margins. Next question came from Seth Gilbert at UBS.
Seth was doing some math on the guidance. He asked if the guidance implies a deceleration in enterprise growth, assuming the online business remains flat or slightly up.
Michelle clarified that online growth is actually being driven by a price increase on the annual SKU and some value additions. But she reaffirmed that enterprise remains the durable driver for the future.
Fueled mostly by Zoom Phone, which is seeing mid-teens growth, and AI monetization. She really wanted to make sure nobody thought the enterprise engine was stalling out.
Definitely. Moving on to Tom Blakey from Cantor Fitzgerald.
Tom wanted to quantify those credits, or grace periods we talked about earlier, and he also asked for clarification on the SMB small and medium business opportunity.
On the credits, they confirmed again that those grace periods for customers switching to Zoom are the primary reason for the lower Q1 deferred revenue guide.
And on SMB, Eric made a very important distinction. When he says SMB, he means higher-end SMBs that need rich portfolios like phone plus contact center plus AI.
So we are not talking about a freelancer buying a single pro license.
Exactly. He's talking about established small businesses with actual IT needs. Michelle also noted that the BrightHire acquisition was sub-$100 million, so it has a fairly small, immediate financial impact.
That distinction on high-end SMB is crucial for understanding who their target market actually is right now. Next up, Samad Samana from Jefferies.
Samad asked about their pricing philosophy for FY27. How are they balancing value creation with price increases?
Michelle announced a very specific number here. A 6% price increase for the online annual SKU effective mid-March.
But she stressed this isn't just a price hike for the sake of it. It reflects added value like the new AI features and the whiteboard tool.
And for enterprise?
For enterprise, the focus is on total contract value, not standard baseline price increases.
A 6% hike on online is significant, but if they are adding enough features, they are betting those customers will stay.
Yeah. Next, we had a question from Chris asking on behalf of Ryan McWilliams from Wells Fargo.
This one loops back to that coding discussion. He asked if AI coding tools are actually improving Zoom's own product velocity or development speed.
Eric confirmed that yes, AI tools have absolutely accelerated innovation, specifically for features in the Zoom virtual agent and a lot of UI work. But he reiterated that AI is not yet powerful enough to maintain their legacy C++ core code. It's a great reality check. AI helps with the new shiny features, but human engineers still need to manage the deep, complex infrastructure.
That is a fascinating dynamic. Okay, next question from Jackson Ader at KeyBank.
Jackson asked about channel partner enhancements and if the margin guide reflects a mixed shift between channel and direct investment.
Michelle emphasized that the channel is absolutely essential right now, especially for phone and contact center. In fact, 9 of the top 10 in customer experience deals were channel deals.
Regarding the operating margin guide of 40.5%, she said it's primarily influenced by an accounting amortization change, which gave them a 180 basis point tailwind offset by a shift from stock-based compensation to cash bonuses.
Almost there. Next was William Power from Baird.
William asked what exactly is driving the recent wins displacing Cisco and other legacy providers. Is it faster sales cycles or is it product quality?
Eric didn't hesitate on this one. He identified AI as the primary driver. He said legacy on-premise phones simply cannot leverage AI, which is forcing these companies to migrate to the cloud.
And Michelle added a staggering stat here. There are still about 150 million on-premise seats in the market.
150 million seats still sitting on old, non-cloud hardware.
Yes. That represents a massive opportunity for Zoom to capture as those companies eventually have to modernize.
Wow. And finally, our last question from Catherine Trebnick at Rosenblatt Securities.
Catherine asked about bundling trends. Are enterprises moving toward a platform play, buying phone and contact center together?
Michelle confirmed that yes, bundling is really intensifying. Customers want that full system of action.
And Eric noted the basic ROI logic. If you can combine unified communications like your phone and video and contact center into one AI-driven platform, it just makes financial sense for large customers.
And that wraps up the Q&A gauntlet.
Phew, that was a lot of detail.
It was, but it paints a really clear picture. So let's zoom out, pun fully intended, and look at the high-level wrap-up. What are the main themes you want people to take away from this?
If we synthesize everything we just heard, I
Yeah.
think four things stand out. First, the system of action. Zoom is aggressively rebranding. They are not just a meeting app anymore. They are an AI-driven workflow platform.
Right. And the second theme is AI monetization.
Exactly. It is no longer theoretical. Custom AI companion, Zoom virtual agent, contact center, these are driving real revenue right now. It's not just hype. It is actual cash.
And the third theme.
Competitive strength. They are successfully displacing legacy providers like Cisco and Avaya, and they are winning against big tech like Microsoft in very specific verticals like phone and contact center.
And finally, the financials.
They are growing. They're about to cross $5 billion soon. They are profitable, and they are using their cash for buybacks with a $3.7 billion plan active. It's just a very disciplined, mature company.
It really feels like they are fully turning the corner from being the pandemic darling to a serious, long-term enterprise utility player.
Yeah, they really are.
It leaves you with an interesting thought to mull over. Eric mentioned that AI isn't quite powerful enough yet to rewrite their core mission-critical C++ code. But with AI advancing so fast and 150 million legacy on-premise seats out there ripe for the picking, what happens to the market landscape when AI finally can manage that deep infrastructure?
That is the billion-dollar question.
It really is. Well, thank you so much for breaking that all down with me, and thank you to everyone for watching the video. We hope this analysis helped you understand what is really going on under the hood at Zoom.
It's always fascinating to see how these tech giants evolve in real time.
Absolutely. If you liked the video, please click like, share the video with a friend or colleague who needs to know this stuff, and subscribe to stay tuned for upcoming content. We will see you next time.